Hello and welcome to Allsop Prop Chat. Today I'm joined by Andrew Hoban, partner in our commercial valuations team even, and we're going to discuss the tips and recommendations for investors refinancing their debt and property assets, whether that's a single asset or a portfolio of assets. The background to today comes at a time when the Bank of England had been raising interest rates from an historic low of 0.1% all the way up to 2.25% that it is today. Rates are expected to reach, according to Lloyds Bank in the Times this morning, 4% in December. And this has drawn many investors and banks to seek valuations on their properties, whether that's existing properties or acquisitions. With valuations increasing in volume and this time pressure that they're under, what can prospective clients do to help speed up and improve the validity of their valuations? So this brings us on to our discussion this morning, Andrew, and welcome. So what hints and tips can you provide to potential clients to help them in this regard?
Thanks, Ben. I think there's two strands to it. On the one hand, you want to ensure you maximise value, and on the other, you want to ensure that you're organised to undertake a timely refinance process. And I think this is really pertinent if you're moving between lenders. So if you are refinancing, you're likely to find that there's more due diligence involved from the initial credit approval stage through to the instruction of solicitors to act on the lender's behalf. So I've got 5 suggestions for you, Ben, that I think might help smooth that process. The first thing I want to touch upon is looking at the rental payment history of your tenants and the tenant covenant strength. Since COVID, investors and indeed lenders have felt the pain of non-rental payments, either as a result of the moratorium on rental payments or because of tenant default. As a valuer, I'm asking borrowers for confirmation of rental arrears and details of rental payment history. There will be instances of non-rental payments, and where those occur, I want to see evidence of a payment plan in place and be asking the questions: are the tenants up to date with rental payments? Did the tenants continue to pay during lockdowns? So if you're able to answer those questions and provide details to the valuer, that's going to give them comfort in knowing that the rent's going to be paid.
And is there anything anyone can do to help provide shed some light really on the covenant strength? How would you judge covenant strength, Andrew?
There's two key ways of doing that. I think the first is obviously looking at the balance sheet, undertaking a credit search check on the tenant. That's one way of doing it. And the other is, of course, looking at that, the ability of the tenant to pay the rent. So if you see that good level of rental payment history, that's going to give some comfort. The other thing to mention, and that's if the valuer isn't reviewing the lease, just making sure that if there is a guarantor, making the valuer aware that there's a guarantor in place. And indeed, if there's a deposit held on file, what's the level of deposit that's held? So those are additional things that'll give the valuer comfort. The second thing I want to talk to you about are tenancies. This might sound very obvious, but it's always good to go over straightforward ground. Where there are lease events, either rent reviews or lease expiries, provide detail to the valuer as to what is happening. This might sound really obvious, but if there's an outstanding rent review, who's the rent review surveyor dealing with the process? If there's a lease renewal being undertaken, provide some background and detail. The other thing here which might help and might be a suggestion that you could make to your lender, whether it's an existing or new, and that's in the case whereby you have a lease renewal, you might suggest a special assumption. So I dealt with a property recently where there was a major bank as a tenant. The property was being, or there was a lease renewal being undertaken, and so we put a special assumption valuation in there on the assumption that the lease had been completed, which resulted in a higher value. And throughout that process, that lease completed during the refinancing process, the bank was then able to lend off the higher value. So that's a good thing to do that.
So it's all about providing clarity, a bit of colour on the tenants, on the tenancies, who's behind it.
Absolutely. And in terms of
going back to this risk factor again, isn't it?
It's about managing that and being open and honest, and also where there are moving parts, and of course the moving parts to every property, is being a little bit creative there in terms of what you might give as a special assumption, because things do change, but that can help save you time in what can be quite a lengthy process, and also help you save you money because you don't need a revaluation.
And a delay in this process could result in a higher interest rate at the moment anyway.
Absolutely, yes, that's right. So yeah, in month to month, we're seeing increased cost of debt. It's more important than ever.
Time is of the essence.
It is. The third thing that's certainly worth mentioning are EPCs. Now, earlier this year, I know you put together a very helpful podcast about 5 easy wins in terms of improving your EPC rating. I recommend you listen to that if you haven't done so already. Me, as a valuer now, I'm telling you that lenders are more concerned about these than ever before. And we as valuers are also concerned about EPCs, particularly in terms of the minimum standard of E. And with the looming deadline of a minimum standard of C by 2027, this is now more important than ever. So one of the first things to do, this is going to sound very obvious, but make sure you have an EPC in place. And then the next step, if the property falls below the minimum standards or close to that minimum standard of E, is perhaps providing your valuer with some detail in terms of the costs to bring the property up to standard. So a note from your contractor, a breakdown as to what might be required to help improve that, is going to provide the valuer some comfort so they can reflect that cost rather than use their own costings in the valuation.
And to all out there, I mean, there are some, as our podcast would tell you, there are some very easy, quick, and not so expensive fixes to your EPC. There are ways you can, improve your EPC score pretty simply and low cost. So I'd highly recommend you have a listen to that. And if anyone does need to check, see if they have an EPC already on a building because they're not sure, the government has a very helpful website. It's a government portal. It's called the Domestic and the Non-Domestic EPC Register. So if you just put that into your search engine, you'll be able to look for any property in the country and see if it has an EPC, and you can check to see if it's valid as well. It's a really helpful resource.
So the fourth thing I want to talk to you about, Ben, is the prospective development opportunities. A good valuer will always pick up on a development opportunity. A lot of what we do at Allsop is look at income-led and investment property. That's a lot of what you sell at auction, Ben. And so there might not necessarily be any development plans in place or consent in place for redevelopment. But if you've got maybe medium long-term income and there is an obvious opportunity to redevelop, have you consulted maybe with an architect or a planner in terms of the development potential, the massing, the plans, and you provide those to the valuer? That's going to help when looking closely at the initial yield on your existing income.
And I mean, bill costs are rising. Inflation is pretty rampant at the moment in the UK. Bill costs are rising at quite a rate at the moment. I was looking at a piece earlier in the week, actually, and from the start of the year to today, my bill costs had gone up 9%. And even then, the view was actually that might actually be on the light side. So bill costs will make up such a large part of these development properties. How can somebody help you with that?
We have to analyse and look at the validity of bill costs, and we use our own sources internally and also use benchmarking to provide an assessment of bill costs. Now, if you've got a JCT, a joint contract tender in place, and you provide that to the valuer, that's great. That gives some certainty. But if there's nothing formally in writing, but there's a contractor you're using and you've got some evidence that you can show you can do it cheaper than the average rate, provide that to the valuer. They may well be able to adopt that bill cost within their appraisal. And that will, of course, make a big difference if you're looking at a residual valuation.
Brilliant. Thank you.
And the final thing is in relation to a vacant space. If you've got vacant space, have you thought about a rates mitigation scheme? And if so, can you provide details of the rates mitigation scheme? We can work that through and offset some of those costs, which is going to, again, improve your value. If you don't know about rates mitigation schemes, our rating team at Allsop can potentially assist with that, but it's something to consider, particularly if you've got relatively big vacancies or you're maybe undertaking a development opportunity where you've got a void for a reason. There are ways we can potentially offset that cost. So it's certainly worth thinking about.
Brilliant. Thank you, Andrew. Well, that concludes our hints and tips for your valuations and how to help speed up and assist the valuation process. And of course, if anyone has any questions or would like further details on this, please do get in touch with Andrew directly. And I'm sure he'd be delighted to help you. In the meantime, thank you for listening, and we hope to hear from you again soon.
Thanks very much.